Here's a confession the financial world would rather I kept quiet. Most financial advisors won't make you rich. Many will quietly make you poorer. Today I'll show you exactly why and precisely how to spot the rare good ones. Here's the uncomfortable truth. The person managing your money may have never been required to put your interests first. Not legally, not ethically. Their job in many cases is to sell you products. Yours is to fund their commission. Stay with me because the stakes are enormous. Over a working lifetime, the wrong advisor can quietly drain hundreds of thousands of pounds or dollars from your retirement, not by stealing, just by charging, perfectly legally. And here's the twist. I shall prove by the end, study after study shows most professionally managed funds lose to a simple index fund you could buy yourself in 10 minutes. You're often paying a premium for worse results. Now, fair warning, this isn't a hit piece on every advisor. Genuinely excellent ones exist, and the good ones earn every penny. The trouble is telling them apart. By the end, you'll know exactly which questions expose the difference. Let's start with the costume. Anyone, truly anyone, can print financial consultant, wealth managers, or retirement specialist on a business card. Those titles carry no legal weight whatsoever. They're marketing. The fancy office is marketing too. Here's how many of them actually get paid. Commissions. Sell a particular mutual fund, pocket a cut. Sell a whole life insurance policy, pocket a bigger cut. Sell an annuity, and the commission can be frightfully generous indeed. Think about what that incentive does. When someone's pay depends on what you buy, the question in their head isn't, what's best for this client? It quietly becomes, what's the best thing I can sell this client? Different question, different outcome. Now for the single most important phrase in this entire video, fiduciary duty. A fiduciary is legally required to act in your best interest, full stop. Most people assume every advisor works this way. Most people are wrong. Many advisors operate under a weaker rule instead, often called a suitability standard. Suitability means the product merely has to be acceptable for someone like you. Not the best option, not the cheapest, just not outrageous, rather a low bar. Picture buying a car where the dealer only had to sell you something suitable. You need a hatchback, he's paid triple to move the luxury saloon. Guess which one is suddenly perfect for your lifestyle? Money products work the same way. So when the nice chap in the nice suit recommends a fund, you genuinely can't tell from the outside whether it's the best fund for you or the best commission for him. That ambiguity is the whole problem. Right, let's talk about the damage, because fees are where this gets truly ghastly. A typical arrangement charges around 1% of your assets every year, plus the funds they pick often charge another 1% on top. 2% sounds adorable, doesn't it? Practically a rounding error. But fees don't behave like normal costs. They compound. The same magical force that grows your money works in reverse, growing what you lose year after year after year. Run a rough example. Invest steadily for 40 years earning 7%, and a 2% annual drag doesn't cost you 2% of your wealth. It can consume roughly 40% of your final pot. Read that again. In plain money, that could be the difference between retiring with $1 million and retiring with 600,000. Hundreds of thousands gone. Not to bad luck or a market crash, but to a quiet line item you never questioned. And mind you, that advisor fee gets charged whether you make money or not. Market up, they're paid. Market down 20%? Paid all the same. It's a marvelous business model for them. Heads they win, tails they win. Compare the alternative. A broad index fund can cost a few hundredths of a percent per year. Not 1 or 2%, hundredths. Same market, same growth engine, a fraction of the toll booth. Keep that contrast in mind. So before we go further, do the maths on your own accounts. Find every fee, the advisor's cut, the fund's expense ratio, any platform charge. Add them up. If the total tops 1%, you deserve a jolly good explanation. Now, perhaps you're thinking the fees are worth it for expert stock picking. Splendid theory. Let's test it. Researchers have compared professional fund managers against plain index funds for decades. The results are, frankly, a little embarrassing. Study after study finds the same thing. Over long periods, the large majority of actively managed funds fail to beat their benchmark index. Over 15-year stretches, the failure rate is often around 90%. 9 in 10 professionals losing. And the rare managers who do win one decade rarely repeat it the next. Today's genius is tomorrow's also-ran, which means picking a winning manager in advance is roughly as reliable as picking lottery numbers, with higher fees. Even one of the most famous investors alive made a public million-dollar wager that a simple index fund would beat a hand-picked team of elite hedge funds over 10 years. The index won. It wasn't particularly close. Sit with that number for a moment. If world-class professionals with research teams and supercomputers can't reliably beat the index, the friendly chap at the local branch office almost certainly can't either. He's just better at lunch. Now for the balance, because I did promise fairness. Good advisors absolutely exist, and for the right person, they're worth every penny. The title of this video says most. It doesn't say all. The difference matters enormously. The good ones share a profile. They're fee-only, meaning they're paid by you and only you. No commissions, no kickbacks, no prizes for selling a particular product. When the conflict of interest is removed, the advice changes character entirely. Many charge a flat fee or an hourly rate, the way a solicitor or an accountant would. You pay for advice, you receive advice, and the bill has nothing to do with which product you end up holding. Refreshingly honest arrangement. Credentials help too. A certified financial planner, a CFP, has passed serious exams and accepted real obligations. It's not a guarantee of brilliance, but it filters out the chancers who simply printed themselves a grand title last Tuesday. And here's what a genuinely good advisor is actually for. Not beating the market. Nobody reliably does that. They're for the human stuff. Tax strategy, estate planning, insurance gaps, and above all, stopping you from panicking at the worst moment. That last one is worth real money. Investors who panic selling crashes and buy back late routinely earn far less than the very funds they own. An advisor who simply keeps you seated through the storm may pay for themselves. So how do you tell the salesman from the professional? 3 questions, asked politely and directly. First, are you a fiduciary at all times with all my accounts? The only acceptable answer is an immediate, unflinching yes. Second, how exactly are you paid and by whom? Listen for hedging. If commissions, product fees, or third-party payments enter the answer, you found your conflict. Third, what will I pay all in every year in pounds and pence? Now the red flags. Memorize these. A free steak dinner seminar. Guaranteed returns. Pressure to decide today. Products you can't explain back to them in one sentence. Any one of these and you walk. Briskly, without dessert. Guaranteed returns deserve a special harumph. Real investing involves real risk. Anyone promising double-digit gains with zero downside is describing something that doesn't exist or something dreadfully expensive wearing a disguise. Either way, your wallet should sprint. And if your situation is simple, steady income, standard retirement accounts, no complicated business or estate, you may not need an advisor at all. A boring broad index fund, bought automatically every month, beats most professionals over time. Your homework this week, should you choose to accept it, pull your statements, total your true annual fees, and if you use an advisor, send one short email asking the fiduciary question. Their answer will tell you everything. And take heart. You don't need a finance degree to protect yourself. You've just learnt more about advisor incentives than most clients ever do. Asking one direct question about money isn't rude. It's the whole point of being the customer. Recap then. Most advisors are salespeople under a weaker suitability rule. Fees compound viciously against you. Most pros lose to the index. The good ones are fee-only fiduciaries who coach your behavior. 3 questions sort the lot. Marvelous. Now, do tell me in the comments, have you ever asked an advisor how they're paid and what did they say? I'm frightfully curious. If this saved you a fortune, a like, subscribe and share would be splendid.